Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into some concerning news about Toronto's real estate market, specifically the mortgage delinquencies that have reached their highest point in over a decade. According to new data from Equifax, the delinquency rate in Toronto's census metropolitan area surged in the first quarter of 2025. This isn't just a local issue, it's part of a broader national trend, but Toronto's situation is particularly pronounced.
That's right, Steve. While mortgage delinquency is a national story, what's happening in Toronto is strikingly different from the normalization we're seeing in other Canadian markets. Over the past few years, Toronto's delinquency rate has more than tripled, reaching a multi-decade high. It's important to remember that a mortgage delinquency rate represents the share of total mortgages that are at least 90 days past due.
Exactly, Janine. It's really about liquidity. When people can't manage their mortgage payments, they often try to sell their homes, regardless of market conditions. Foreclosure only becomes a reality if they can't find a buyer, making this more of an issue of liquidity rather than consumer health per se. In Toronto's case, the delinquency rate climbed 2 basis points to 0.22% in the first quarter of 2025, marking a 10% rise within the quarter. That's an 8 basis point increase from last year, translating to a 58% increase overall.
And Steve, Toronto's rate is now the highest it's been in at least 12 years, which is quite staggering. The rapid escalation in the delinquency rate is unprecedented when compared to other major cities. While many markets have seen an increase, none have experienced such a rapid rise. It seems like after a nearly 26-year period where the market felt invincible, there's now a sudden shift with sales plunging to multi-decade lows for both new construction and existing homes.
Yes, and despite having the most inventory on record, prices remain high. This combination of factors explains why Toronto's delinquency rates have risen so much faster than the national average and other major cities. It's a complex situation, and it'll be interesting to see how the market adjusts moving forward. According to a report from TD Economics, mortgage payments across Canada are trending lower, despite many households facing renewal strain. It's a bit of a mixed bag, Janine, because while some borrowers are feeling the squeeze from high-rate renewals, others are benefiting from early relief due to rate cuts and short-term mortgage resets.
That's right, Steve. It's interesting to see this duality. On one hand, about 60% of mortgages are set to renew by the end of 2026, and 40% of these will likely renew at higher rates. For example, someone who locked in a $500,000 mortgage at 2.5% in June 2020 could be looking at a renewal rate closer to 4.0%, which would increase their monthly payments by roughly $320.
Exactly. But what's fascinating is that national mortgage payments are actually declining. Economist Maria Solovieva from TD Economics explains that this is because the national mortgage payments are calculated based on total dollar volume, not the number of households. This means that borrowers with larger mortgages, who often took out variable rate or short-term fixed loans, are now seeing significant relief.
And Steve, those with larger mortgages are seeing their payments drop significantly due to the Bank of Canada's easing in mid-2024. More than 1/3 of the upcoming renewals fall into this early relief group, which is good news for those rolling over one-year terms or variable rate mortgages.
Yes, but it's important to remember that not everyone is better off. About 40% of renewals will come from those who locked in ultra-low rates in 2020 and 2021, and they are more likely to face payment increases, especially during the peak renewal period in late 2025 and early 2026.
That's a good point, Steve. However, the report suggests that panic isn't necessary because many Canadian homeowners have more equity and savings now. Since early 2020, the National Home Price Index has jumped 25%, and household financial assets are up 45%. This gives homeowners some flexibility to manage the increase in their monthly payments.
Right, but there are still risks, particularly for lower income borrowers and those in high cost regions like Ontario and British Columbia. TD expects unemployment to peak at 7.3% in the fourth quarter of 2025, which could coincide with renewal periods for many borrowers.
Yes, and non-mortgage borrowers are also feeling the pressure. While these debts are just 25% of household liabilities, they account for 45% of debt servicing costs. Many of these products carry shorter terms and higher rates, which is increasing defaults.
It's clear that the mortgage landscape is complex, with many moving parts. It will be crucial for homeowners to stay informed and consider their options carefully as they navigate these changes. Let's shift gears and talk about a recent report from Bank of America that suggests a potential rebound in Canada's housing market. This is particularly interesting as it comes amid ongoing trade tensions and economic uncertainties.
Yes, Steve, Bank of America analyst Ibrahim Poonawalla has pointed out that if trade tensions ease and consumer confidence returns, we might see buyers re-entering the market. This could be a turning point for the housing sector.
Absolutely, Janine. Poonawalla highlights the optimism around Canada's macroeconomic trajectory and policy developments as key drivers for this potential rebound. It's crucial for the Big Six banks to capitalize on this momentum, but they also need to diversify their focus beyond just mortgages.
That's an important point, Steve. While the housing market shows signs of life, Bank of America emphasizes that banks should not overly rely on mortgage-driven expansion. They need to look at other avenues for growth, especially with the recent infrastructure initiatives and policy changes.
Exactly. Poonawalla raised the price targets for all six major banks, with the Royal Bank of Canada receiving the largest upward adjustment. This shows confidence in their economic resilience and supportive government policies, but it's a reminder that they should also focus on innovation and infrastructure for sustainable growth.
And Steve, let's not forget that Fitch Ratings has flagged elevated credit risk due to ongoing trade tensions. Even though mortgage impairments remain low, there's a warning that a severe downturn could change that trajectory. It's a reminder of the importance of being prepared for various scenarios.
Right, Janine. And while Buffet economists expect GDP growth to pick up, they also note that rising impairments in unsecured retail and commercial lending could pose challenges. It's a complex landscape, and banks need to be agile in their strategies.
Agreed, Steve. The focus should also be on how government policies tied to innovation and infrastructure can drive long-term growth. The recent Senate approval to fast-track infrastructure projects is a positive sign, but banks will need to align their strategies accordingly.
And with the Bank of Canada's upcoming decision on interest rates, it'll be interesting to see how these factors influence their path forward. Cuts are anticipated, which could offer some relief, but the overall economic environment remains a key consideration. Let's switch gears, Janine, and talk about the recent movements in the Canadian dollar and benchmark yields. According to a report from Reuters, the Canadian dollar experienced a slight weakening this week, while the benchmark yield saw an uptick.
That's right, Steve. The Canadian dollar fell by 0.1% against the United States dollar, reaching 1.33 per US dollar. This decline is attributed to various factors, including global market dynamics and domestic economic conditions.
Exactly, Janine. It's important to note that the increase in the benchmark yield was driven by a rise in bond yields. The 10-year yield climbed to 1.75%, reflecting investor expectations of future interest rate hikes by the Bank of Canada.
And Steve, while the weaker Canadian dollar can make imports more expensive, it could also boost exports by making Canadian goods more competitive on the international market. This could potentially benefit our economy in the long run, despite immediate challenges.
That's a good point, Janine. However, For Canadian consumers and businesses that rely heavily on imports, this could increase costs, affecting their purchasing power and profit margins. It's a delicate balance that policymakers need to manage carefully.
Indeed, Steve. As we continue to navigate these economic shifts, it's crucial for both businesses and individuals to stay informed and adapt their strategies accordingly. Whether it's adjusting investment portfolios or reevaluating spending habits, being proactive can make a difference.
Absolutely, Janine. As always, staying informed is key. And with that, we've wrapped up today's insights. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.